guys, welcome to another video of fin241, subject University of Wollongong, Dubai. Here is Tariq Muhammad from Group D, 5718260, ID number. So here I'm going to answer the problems of week 9 basically, and we'll start by the first question. If the consumer price index for the United States rises from 350 at the end of a year to 365 at the end of the next year, how much inflation was there in the United States during that year? So the answer is basically calculating the rule of inflation, which is price index after 1 year divided by price index today minus 1. So in order to apply the numbers to that formula, we'll get 365 divided by 350, which will be 1.04 minus 1. So the total amount of inflation will be 0.042. Well, moving on to the next question. As a with features trader, you observe the following futures prices for the purchase and sell of wheat in 3 months.
Hi everyone, me and my team will present on week 10 tutorial questions. Alright, good morning everyone. My name is Mohammed and I'll be starting with the question 1. Should MNC borrow primarily short-term when short-term interest rates are lower than long-term interest rates? Or should it keep the maturities the same but use a floating rate loan rather than a fixed rate loan? Explain. Firstly, the short-term interest rates are lower than long-term interest rates, which signifies that there has been a significant increase in the interest rates. Whereas if the interest rate is constant, then it has been understood that the long rate is considered as weighted average of short-term rates. Loan that is having a floating interest rate allows for low interest payments when short rates are said to be low, and high interest payments when short rates are high does not provide any result. Secondly, the difference between borrowing the short term and using a floating rate note, the note could create various negative impacts in the future on MNC's credit spread. But last but not the least, if the firm is assured that its credit rating will be improved in the near future, then it may not be willing to issue a floating rate note, whereas instead of issuing a floating rate note, it will be willing to borrow a short term and also a good credit spread. So now moving to the second question, which states that what are the two main segments of the international bond market and what types of regulations apply to them? The two main segments of the international bond market are foreign bond market and the euro bond market. Under the foreign bond market, the foreign issuer issues bonds in a given respective domestic market, and in the Eurobond market, the bonds are issued contemporarily in various markets outside the national boundary of a given country.
Hi guys, how are you doing? Welcome to another video of week 11 tutorial task. This is Tariq Muhammad from Group D, ID number 5718260, fin241 subject. University of Wollongong in Dubai as well. Alright guys, so here is the questions for week 11. The questions were divided to the groups, and I've picked question number 3 to talk about and discuss about it. The questions say the following: briefly discuss the function of the NASDAQ, Nasdaq Dubai. Alright guys, so briefly, like in 6-7 lines, I'm going to explain and talk about Nasdaq as much as I can. To start up with, Nasdaq Dubai is the Middle East International Financial Exchange, so it's basically an exchange. It combines regional and international wealth making it a global unique platform for companies in order to raise their financial income, to raise their money, and for investors to find like better opportunities to invest and exciting opportunities as well. Nasdaq Dubai listed companies may trade their securities globally, which gives an instant recognition and visibility.
I'm going to answer question 5. What the credit rating? What's a credit spread? Should corporations issue bonds in countries where they face the lowest credit spreads? Be very specific about the concept of credit spread you use. Credit spread is one of the most crucial indicators that help investors to make better decisions. Concerning their debt security purchases, the term is defined as the difference between the yields of two bonds with similar maturity dates. Usually the comparisons are benchmarked against the risk-free debt securities, such as U.S. government bonds. In such cases, credit spread indicates the number of default risk that investors embrace purchasing debt securities of certain organizations. It is also important to mention credit rate, as this concept is closely related to credit spread. The former is determined by private entities such as Moody's and Standard and Poor's and shows the trustworthiness of bond issuing organizations based on the firm's ability to service one's debt. Therefore, to raise capital, a company should set the interest rate adequately representing its credit rate and credit spread with benchmark bonds. Only when would an organization be able to balance the potential risks with potential benefits? For this reason, it is argued that companies should seek to issue securities debts in countries where they face the lowest credit spreads due to lower borrowing costs and higher investor trust. Based on the previous description, the formula to calculate credit spread will have the following form. For instance, suppose that the 10-year U.S. government bonds yields is 1.5%, whereas some organizations' bond of a similar maturity date has a yield equal to 4.5%. Then the credit spread between those two debt securities would be 4.5% minus 1.5% equal 3%. Overall, the concept of credit spread, its importance, and its relation to credit rating were discussed. It was determined that credit spread indicates the number of risks that investors embrace purchasing debt securities of certain organizations. It is calculated as the difference between risk-free and the corporate bonds yields, where the former usually represents the debt securities issued by governments. Moreover, it was found that credit rate can influence credit spread. Next, let's make a decision how FE company to raise 1 million with debt financing. Here we can see we have two options. Let's analyze them and make an appropriate decision. London Interbank offered rate indicates the average interest rate that major global banks are willing to set for the loans to other banks, and thus serves as a borrowing rate benchmark for other organizations. ICE Benchmark Administration publishes data on overnight, 1 week, 1, 2, 3, 6 months, and the 1-year interest rates for 5 currencies, namely dollars, pounds, euro, Swiss franc, and yuan. In this regard, as of August 16, 2021, the 12-month interest rate was equal to 0.24%. It means that the floating rate that FE company will need to pay the first year would be 1.24%. However, the amount of bond returns after the second year is unclear. For this reason, it is necessary to forecast what the LIBOR can be on August 16, 2022. It is suggested to use the average predicted interest rate in the countries where the LIBOR sample banks originated from. Such a decision is explained by the logic that the bank's borrowing rate would not differ hugely from the nation's indexes. Therefore, the proposed model has the following form. The panel consists of 16 banks, where 10 banks are located in the UK, 2 banks in Japan, and 1 bank from Netherlands, France, Canada, and Switzerland, according to the forecasted interest rate from the OECD website. Following the form, we got the 0.003% result. The results of the developed equation suggest that LIBOR rate on August 16, 2022 would be very close to 0. Similarly to 2021, therefore, considering the additional 1% of interest, it can be argued that the overall bond returns will be probably not exceed 1.5%. As a consequence, FE companies' overall coupon payments for 2 years would be approximately US dollars or even less.